Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Hey, wait, oh, hold on. This song is already at the end. Let's start a new song. All right. Good morning, everybody. It's Friday. It's been a busy week, I'd say, on the market front, hasn't it? Today is a big options expiration. And I guess the internet's going to be all abuzz because they are going to release the sealed testimony from the Epstein case. I think everybody's going to be disappointed, but we'll see. Good morning from the future, says Abe Hall. Thank you. From the future. Good morning from Lakeland, California, says Kevin. Well, welcome to the stream. We have a lot of people from Florida. Octavius is from Florida. Uzi's from Florida. I haven't seen Uzi in a few days. You're still there, right, Uzi? I was assuming that, you know, he's still there. He's just been quiet, but maybe he's been busy. I don't know. Hey, let's go over the charts. Treasury's kind of been a little bit on the upside still. So yesterday, I'd say we got a pretty good buy after that, the consumer, sorry, what do we call it? Retail sales. Yes, after retail sales, pretty good buy after that, even though the retail sales was stronger than anticipated. But I think what we're seeing here is retail sales were good, but it wasn't necessarily showing inflation when you dig into the numbers. And we're getting stuff from like Waller. Waller thinks we could cut rates. I think Waller is one of those guys that's like actively campaigning to become Fed chairman, right? But so we've been on the up, and look, we have been able to cancel out that huge sell that we got after the CPI, which also didn't make much sense either. Anyways, so S&P 500 good yesterday. Still, I mean, it's just like a marginal new high, right? Marginal new high. Oil, that's kind of an interesting little formation there. Gold and silver, looking pretty random here within this range. The silver's, nah, I don't know. That's probably not one that's able to just break out again. But why do I not have the crosshairs on that one? There we go. There you go. Copper. Ooh, copper getting a little bit of a boost today. That is a slight break from the pattern. I don't think that necessarily means anything, but it does make the action interesting. And the Japanese yen. So there was inflation data last night, but that turned out to be not that significant. They are having an election this weekend for their House of Representatives or something like that. So the dollar, well, the dollar was looking pretty strong yesterday, but it's given up some of those gains today. So with it being an options expiration, my guess is that they will try and push it as far as it can go today on the buy side. Clearly the calls have won, right? I think they're gonna, it's new all-time highs. I think they're gonna try and push it as far as they can. So I think my play for today, if I was taking it, if I made trades in SPOOs, would be long SPOOs before the open. That's a little bit more speculative on the informational inefficiency than I would like, but I think it's within range. I think that's a trade we could take. the options expiration is going to be an awfully big one today. So I think that's probably a pretty good guide for what you do. And I guess we should talk about the Epstein thing too, even though like my better judgment kind of says don't talk about it. But so first, what happened last night? I think it was the Wall Street Journal released a report that basically didn't tell us anything new, but included a letter that Trump supposedly wrote to Epstein. That was really just like a naked woman with Trump's signature. The bottom is like the bush. So a lewd greetings card or something like that, right? Donald Trump reacted to that very, very strongly. I wouldn't read too much into that because Donald Trump's strategy is attack, like full pedal to the metal every time, regardless of whether the accusation is true or false. So I wouldn't read too much into that. And then Donald Trump said, oh, they're going to unseal the grand testimony. Now, one mistake that I think people are making with this is that they think that the two are related, that like because that letter came out, Donald Trump has decided, okay, let's unseal the grand testimony. That's not true. It takes a little bit of work to do this. They had been working on it probably all week. So it's probably the case that they were bothered by the public reaction to it all week and have been working all week to unseal the grand testimony. So I will speculate here. I will make a prediction. I think that the information is going to come out and everybody's going to read it and they're going to be like, oh, there's nothing here. I think that people are going to be disappointed with the information that they're going to get. Because what is in there? Supposedly what is in there is mostly information from accusers and information trying to impugn the integrity or make people question what the accusers were saying. And if there was anything that the accusers had said that directly implicated somebody else other than Epstein, then they would have prosecuted it. So you're going to find that there's not what people are looking for in there. It's probably not going to say anything about Donald Trump. At which point, people will do what people do, which is they'll come up with all sorts of conspiracy theories about how the list is still out there. They're still protecting some elites, and they need to do something. Okay, what's going on here? The 5-year kind of jumped up there, but the other two did not follow. And I'm seeing some pretty excessive steepening in the curve. That's interesting. I think what's going on in the Treasury market is that people are starting to bet that the Federal Reserve will cave to political pressure. I think that's the play that I'm seeing here. Which is why the primary response of the Treasury market is not to move up outright, but rather to steepen. Because they think, well, yeah, they'll cut rates, they'll cave to pressure, they'll cut rates, but that in the longer term, they're going to have problems, and so it's not going to last very long. Long end should be whacked from here on, yeah. Well, it's really kind of a market that we're not used to, is it? Because usually you make way more trading ZB. Well, of course, you always make more per tick trading ZB. So if you're going to trade like ZF, instead of trading one contract, the equivalent would be to like trade 4 contracts, right? But even if you're trading 4 contracts, on normal circumstances, you still make more trading ZB. But when we're getting a bull steepener, you make more from trading ZF. In this situation, you made more from trading ZF. It moved up 3 or 4 ticks, and ZB and ZN didn't move at all. So that's something we should keep in mind, where the flows are going to be a little bit different, aren't they? I'm taking the ZB catch-up trade, which stopped working for a year. Depth of market, welcome back. You should say, I don't know. I feel like I know you so well now. Depth of market. He usually doesn't say that much, but I feel like we know each other better than just hi. You know what I mean? I'm feeling a little weird today. Like, I don't know. I do not feel 100%. I don't necessarily feel like sick. Maybe that results in a little bit less discipline for me. I don't know. Yeah, is it just because it's Friday? You know, I usually feel so tired on Thursday. I need to order a new... Okay, so I have a problem. Maybe you guys can help me with this problem. When I get to the end of the day, I feel tired. And then I get home, they make dinner, and I eat dinner, and then after dinner I have energy, and I feel like I could go out and do something again. So I really don't feel like working out when I get home. Even if I can. A lot of the time I can't. But like this week I was able to work out. I only worked out one day. So I need like a protein shake. I think that's the solution, is if I get a protein shake at like 2 or 3 o'clock to last me through to the end of the day. And that will help me focus better, and that will help me keep my energy level up. Well, I would used to get my protein from Optimum Nutrition. You guys familiar with Optimum Nutrition? They used to be the best. They were the one that, like, you know, really tasted good and had quality ingredients and all of these sorts of things. And basically what happened is during COVID, bodybuilding.com went downhill and Optimum Nutrition went downhill, and now it tastes like crap. It's got those crappy artificial sweeteners in it that makes everything taste bitter, and I just hate it. It's not good anymore. So I need a new protein powder brand that tastes good, preferably with natural, like, I don't want any stevia or any of those sweeteners. I don't care about that. It doesn't even necessarily have to taste sweet either. Just not the better. Because the problem with stevia is it like stays in your mouth and you have that nasty aftertaste all day. Can't stand it. What is... No. Okay, Treasuries did pull back a little bit. Did I feel like I didn't finish it, but I did. I made my point with the Epstein thing. I didn't harp on it too much. Is that enough? I can leave it there. None of you guys really said too much about it, so we'll see. I guess the thing that I want to point out here is that humans hallucinate just like artificial intelligence does. They don't do it as much. They do it in different kinds of situations, but humans hallucinate. Because, you know, part of what that part of the brain is there to do is to help you act in situations where you don't know all of the facts. So it's really, there's this point where it comes where, you're functioning in a world where there's a lot of information, but you don't have access to all of it. And how do you make decisions in that situation, knowing that the decision that you're making is being made on very, very little? How do you do that? Well, from a logical perspective, you just have to know the outlays and everything and make your decision and understand that executing on the decision probably matters more than the actual decision. As often the case, execution matters a lot, right? So what the human brain does, instead of doing that logically, it convinces you that you know more than you actually do, so that you go and you execute with confidence in your ignorance, essentially. So that's why when people, especially when people feel like they don't have any power, the mind will come up with stuff. It'll imagine scenarios, and then it will look for all of the evidence that it possibly can that possibly coincides with that, and you will just straight up hallucinate things. And it gets to the point where we all think that we've seen evidence that doesn't exist. That's why you get all these situations where it's like, hey, I thought that they had this. Didn't they have videotapes of all the crimes? Apparently not. So people will hallucinate. And more to the point, or what you're about to see next is that when people hallucinate, they have a tendency to double down even when they're shown direct evidence that disproves their theory. So that one is pretty brutal. I feel like this is something about human nature that we very much are often in denial about. We don't want to believe that people are like that. We don't want to believe that we are like that. And once you get red pilled on this particular subject, I guess you could say, it can be a little bit disconcerting and disorienting, because now all of a sudden you're in this place where it's like, okay, if I can do that, how can I trust anything that I think or believe? And you find yourself drifting very quickly, right? The way that you have to ground yourself is you have to have a process, a logical process of being able to figure out what things are true or not true, right? Do we have and a key thing here is what are things that we can definitively prove? For instance, like with this Epstein thing, we can definitively prove that Donald Trump knew Epstein. Okay, so Donald Trump sent Epstein a lewd letter. Is it plausible that he sent that? It's plausible. Plausible. Donald Trump denies it. I don't know. So that's on that point, we can kind of say, well, we can't definitively prove that one. Not yet. And let's just be cautious that our decisions are not or do not conflict with the things that we can definitively prove. Okay. Seth, I have been lately learning about market impact models, or orders where big firms split orders into smaller orders based on these models. Curious, knowing this, how do you use it in practice? Very good. Okay, so one thing, if you go to my website and you go to speculatorseth.com/strategy.html, you can sign up for the mailing list, which I have never used, but You sign up for the mailing list and it will email you a PDF. And the PDF goes into what I'm about to say, but I'm going to say it to you too. Okay. But if you feel like you have a hard, like really want to read something else to really cement it in my mind, go and read the strategy PDF. Okay. So how does this work in practice? So the impact of a large meta order tends to follow a square root law, which is to say that if this is Q and this is I, the impact of, and when I say a meta order, this is an order that you split up into smaller lots. It's too big to execute all at once, so you split it up into smaller lots. Okay. So as you execute over time, how much is that going to move the market, right? So that impact is related to Q with this formula, Y times omega. Man, I don't like the look of that Y. Where's my pad? Y omega times the square root of Q over V is the impact of the order size Q. Okay. It looks like this when you graph it out. Okay. Why does this occur? Why does this occur? That's the next thing. Well, what happens is you have all these guys, they want to pick up inventory or trade at a certain price, right? And they're constantly adding and taking stuff off. And when you start trading, those people, they get filled. So if you spend too much time in a certain area, all of those people, they're filled. It looks like we're getting a little bit of a move here, by the way. It's interesting. All those market makers get filled, and then they say, oh, I can't add any more. So now the amount of latent liquidity in that area is less. And you'll see it often on the DOM in resting liquidity, where it's like they can't even put up 500 contracts. And then the prices above and below that, it's like, thousands of contracts. And it can't get over those, and so it just goes sideways forever, right? That's like over here, these things right here. And it's really crazy how it can go from like, we're having a good move up, and then all of a sudden it just goes nowhere for a little while. What's with that? Right? This is why this happens, is they're exhausting the liquidity at that location. And that makes it difficult for the market to continue moving forward. But you also end up staying in that area for a long time. So this area actually becomes a big advantage for the person executing the large meta order. Basically, the person executing the large meta order, they pull back on how aggressive they're executing. So they decrease the pace of their execution. Maybe they were trading like X thousand contracts a minute, and now they're doing like half or a quarter of that per minute, right? But because we stay in that location for so long, they actually end up executing more volume in that area than anywhere else. Okay. Another way of putting this is that when you look at this model, it's square root with respect to the size of the order, but it is linear with respect to the size of the order imbalance, which is to say, like, if we're looking at cumulative delta, if cumulative delta goes up twice as much, it tends to move twice as much. But what happens is you get into this area and lots of other stuff is going on, and it gets messy in there. So these provide those large meta orders a really good place to execute in. Okay. So the way that you do this, the way that they do this is they do it in waves. You execute until you start getting to this square root law, right? And you back off. When you back off, you're going to get this short-term mean reversion period post-meta order regime, right? And in this, you can execute a ton. And then when the market is kind of done, it's ready to move up again, you do it again. You can execute a ton in here, and then, right? And then you do it again. Now, each one of these waves will be slightly smaller. Okay, so there's something called, I write it here on the screen, Almgren risk, 2 S's. And this is a study that was released in 2000, I believe it was. It's been a long time now. That basically showed, it was basically a model for them to say, okay, if you have to execute a really big meta order like this, how do you do it? Do you do most of it at the beginning or most of it at the end? So there's more graphs that we can make. And so it depends on whether you think that the market is going to, like if you know that the market is going to be moving up anyways and you're buying. And another thing is how risky you are. Like if you're an index fund, you want to take the least risk possible, or maybe you're a hedge fund and you're trying to make as much money as possible, and it changes. And when you go through and you do all of these calculations, there's a couple of ways that it comes out frequently. So for an index fund, it tends to look like this, which is you want to execute the most at the very beginning and then slightly less over time. Until you get to the end, you're doing very, very, very little. Okay. It's actually the opposite if you want to take big risk. So you do a little bit, a little bit, a little bit, a little bit, and then all of a sudden a bunch of, all at once, and then you're done. Okay. So that's why when you see these moves, what's happening is you're doing a leg. You're going to see each one of these legs, 1, 2, 3, are going to be slightly smaller. It's not able to go as far. And part of that is because they're executing like this. Right? There's this much here, and this is 1, this is 2, and this is 3. The legs get smaller. Okay. So what are the practical implications of this for us? Rule number 1, the first trade is usually the best trade. Okay. You want to be able to predict that these guys are going to come in and perform that trade before they start executing it. Or at the beginning, there's a kind of a point where you can kind of say, I don't know for sure, like I can't prove, given the market data, that is happening. But it is enough that if I have a very strong suspicion that it's going to happen, that's enough for me to go that this is a confirmation that it's happening, and that's when you go. Okay. And then after that, there can be a second leg, right? So actually this is what we've been seeing so far. I don't know if today is a great example or not, but we had a pretty good leg there. You can see the change in cumulative delta. The reason I say I don't know if this is a good example is because somebody definitely sold it after that, right? I would prefer to see it come back, but the cumulative delta be relatively constant through here, not see that dip. But after that, you can then go in and say, okay, so somebody did come in and execute a large meta order. Why? I don't know in this instance, but sometimes we know. Sometimes we know, and then we can say, okay, they're executing this meta order because they think that the Federal Reserve is going to cave to political pressure. Okay. Well, knowing that, that might be something that's worth more than just a standard move. A standard move would be about 10,000 contracts, which is what that first leg did, right? So if we knew that that was the reason, we could predict that there will be another leg because we know that there's more volume to come out. So that's when you get what we would call the after she goes the wait for the pullback trade, you can do that one. Okay. And so that's implication number 2. And implication number 3 is kind of implied in that, which is we want to try and predict how much of a change in volume there's actually going to be so that we can predict when the move is over and get our optimal exit. Okay. So those are the 3 main implications based on what we know about market microstructure and how professionals execute that can potentially help you. Now, the big caveat to all of that, and it's kind of implied in everything that I told you, is you have to know that the meta order is coming. Because by the time you can prove that it's there, it's too late. So that's why we spend a lot of time trying to understand how these different institutions work, trying to understand what's going on in the market so that we can predict the moves that other people will make before they make them, which is very, very difficult to do. But the more and more I research, the more I come to the conclusion that if you do not have a fundamental advantage that is like speed or something like that, that just knowing the market better than everybody else and being able to predict what other people are going to do better than everybody else is like really your only option. All of these kind of technical things that people look for don't really work. And you can kind of see it's kind of implied in this thing, right? You don't know that something's happening until here. At which point, it's not going to move as much. And then it's going to come back. Have you ever felt this? It's like, as soon as I get into the position, then it stops moving, and then it comes back on me. That's why. Because you needed to get in over here. You see? Okay, I have some oatmeal that I need to eat. But if you have follow-up questions, we'll answer those. Would love to read more. Okay, so if you want to read more, I mentioned the strategy guide, so you can go and read that. The strategy guide tries to go a little bit more into detail about the things that we can potentially use to try and predict what people are going to do. So, I think it's a really good thing. I would really like to turn that into a larger book at some point. I don't have the time right now. But then the other one is go and read Trades, Quotes, and Prices, Financial Markets Under the Microscope by Jean-Philippe Bouchot et al. And this book is where they really go into the deep math. I'm kind of just giving you the implications. I'm giving you the, okay, here are the implications that we know, and here is what I think those implications mean for you as a retail trader. That's my contribution, is how does this apply to you as a retail trader? For some reason, everybody always kind of assumed that it was only applicable to professionals, and so it didn't really matter to us. I disagree. I think it has very profound implications for us. Not only can it kind of help you, help explain how you kind of have to approach executing, but it also kind of implies places where you're more or less likely to be able to find an edge as a retail trader. You're more likely to be able to find an edge in being informed than you are purely from technicals because of the way that it works, right? But that book goes into the real data science of it, proving, things like how do we know that it follows the square root law? What are the theories that we have about why it follows the square root law? It's a lot of math. It's a lot of modeling. It's very, very intense. There's literally hundreds and hundreds of citations, citing studies, things like this. This is a graduate level textbook. Okay. I don't have it down by my desk anymore because I was afraid that the kids would ruin it. It's in the bookcase behind me. Otherwise, I would just show it to you. But I'll type it. Trades, quotes, and prices. Financial markets under the microscope by Jean-Philippe Bouchot. Etal. There's like 3 other guys, but he's the most famous one. Okay, Greg has a question. Could you also then try to identify the end of a large meta order? Well, you say second leg, but maybe let's just say it's the first leg. And try to catch a trade / scalp in the opposite direction. Yes. So I don't do that one very often. Because here in the Treasuries, this is like really frustrating to be in. Like, catching it here and coming down, you're like taking 2 ticks, and the risk is, okay, so there's a couple of risks here with this trade. Okay, so first of all, I've gotten pretty good actually of being able to identify that we're at this spot. Okay, in the Treasuries, it only comes back a little bit, so the reward for it isn't very good. Okay. The other issue is there's a situation that I have neglected to mention, which is the impact of a large meta order follows a square root law to a point at which the impact just explodes. So this is when the market becomes unhinged. So especially on the downside, these are those days where like you just get complete market chaos, right? This is the market makers are blowing up. Okay. So that's your risk. So it is a small reward, big risk trade. Right? That said, now the next issue is the third thing that I would talk about is, well, in the S&P 500, those pullbacks are a little bit better. So you might be able to do it with SPOOs. And I have seen people that at least claim to be trading like that. They're trading the pullbacks. Basically, they're looking for the liquidity holes and they trade it on it falling back into the liquidity hole. So I think it's a practical thing to try and do. But it's very difficult to do it because of the nature of equity indexes. They're more random. The volume is more spread out, things of this nature. So I think probably the best place to trade something like that would probably be in individual stocks. So I'm working on moving some of my tools over to stocks, over to TradingView at least. So maybe then I could try that particular trade. Personally, I don't really like these trades that have really huge left tails. And that one has a really huge left tail. At the same time, I am very interested in what are some strategies that we can put to practice in here that have low variance. I guess I'm thinking about it a lot because Delta Trend Trader was talking about it, but you know, if what ultimately one of my dreams is that we formulate a strategy that is completely within the rules of all of the prop firms, and that the prop firms can't necessarily predict that that's what you're doing, but that is effective and everybody just starts doing and starts fleecing the prop firms. I want to kill the prop firms by finding a low variance strategy that in the long run is not very profitable, but in the short run causes so many people to pass the combines and take payouts that the business model for the prop firm stops working. So if I can find a low variance strategy like that, preferably one that you apply to the SPOOs, I would just absolutely love it. Could trading the pullbacks be that low variance strategy? Nah, because I've found that even though I'm pretty good at detecting when that situation is occurring, I think that the hit rate on the trade is probably still like a 50-50. So it's like 50% of the time you make 2 ticks, 50% of the time you lose 2 ticks, but then actually maybe 5% of that 50, you just get absolutely BTFO'd. So platforms generally take mean reverting strategy like butterflies to trade the opposite. So when I say prop firms, what I really mean is funded trader programs where you pay to take some sort of a challenge, and then if you make money on the challenge, then they fund you. So that's what I'm talking about. Trading the opposite of butterflies, I don't think that. Well, so a lot of what I'm trying to do, though, is taking the opposite trade. Like, I'm sitting here and I'm waiting for this situation where I know that people are going to try and take these mean reversion trades. But I know, because of the amount of volume that's going to come through and whatnot, that they're just going to get steamrolled. So one of the best trades that I ever took was I don't remember when it was, and I don't even remember if I traded it live or not. I think I traded it live though. There was these guys on Twitter, a pretty popular influencer. You would know who they are. And they were looking at floor pivots. They're like, yep, it's gonna stop here at this floor pivot, so we want to go long here because it's at the floor pivot. And I knew that it was one of those days where there was a huge imbalance, and not because of any news or anything, but just because of what the indexes had to do and all of that they were going to sell it hard. And so I came down and I saw it bounce off of that floor pivot and then win short. And it kept going, and oh man, did it keep going. It was like one of the best trend days of that year. And it's like all of those retail traders trying to trade that pattern, and the pattern breaking down makes it move so much more because of it. So I'm absolutely, I know a lot about retail strategies that don't work. I understand how these price action strategies work. I understand practically every kind of technical thing that you've ever heard of before. And I kind of can't help but see them. I'm pretty good with the data and seeing the data and seeing the patterns, but better than most people, I would say. That's why I know that the patterns don't work, but people do still trade them. So I'm absolutely looking for situations where it's like, I see a pattern and I know that that pattern is going to fail. Because I know what the future volume is going to be. Those are the best trades. Conversely, a similar trade to that, we didn't talk about this one. We should talk about this one. There is the reversal. So you get the square root law thing, right? And then it comes down like this, right? But if somebody starts selling here, it'll do this. The second meta order will have more impact because the meta order in front of it creates a liquidity hole and damages the liquidity. So the place where this sort of a thing will happen is like, we just had an important report, like maybe a CPI report. And, you know, there's a CPI and then it jumps up like this, okay? Bunch of people go long there. And then after that CPI report, some sort of news comes out. Like Donald Trump tweets something shortly after that that has, you know, an implication going the other way. Oh my gosh, take that one. Take that one. That is the best trade. That is the best trade. Because now you have something that strongly predicts orders, and you have a market structure that's also very much in your favor, that they're just going to sweep through all of this. That is an amazing trade. So that's another one. I haven't seen one of those in a while, though. I guess maybe the CPI report was maybe kind of like that, though. Except for that, I don't really know why they sold it after the CPI. So sometimes you get ones where it's like they're waiting for the news. The news comes out, it makes its move, and then something happens after that. And people will say, oh, well, does that mean that the market actually thought better of it and decided that that news doesn't matter, or that that news was negative? Like, that's what we're saying about the CPI, right? Oh, CPI was better than expected. We ended up lower on the day. That must mean that the CPI report was actually bad. No, that's not necessarily what it means, because the meta order that happened after the CPI and pushed us down could be completely unrelated to the CPI. And sometimes we know what they are and sometimes we don't. And in this particular instance, I don't think that we've gotten a very, very good, well, it's summertime, so normally I get enough from like my news and other reporters that they kind of know why people are taking trades by the end of the day. And we didn't get that this time, so I'm not quite sure what was with the selling or with the buying yesterday. Although I suspect that the buying yesterday and today is the market betting that the Federal Reserve will cave to political pressure. That they probably are going to cut in September. That Donald Trump putting the pressure on them is, you know, the thing that will kind of seal it, that they were kind of leaning towards. They're going to cut in September anyways, but now him putting pressure on it means that for sure they're going to do it in September. And then furthermore, that whoever gets put in as chairman next will just be a complete Trump lackey that will try and do everything to keep rates as low as they possibly can. Hence the steepener. Oh, you know what? I'm just realizing something that I didn't mention earlier. Earlier today, we said my play is at just before the open, go long on the theory that they try and push the S&P as high as they can for the options expiration. The corollary to that is my play is also that the beginning of next week will not be very good for equity index futures. When that gamma unclenches. So basically what happens is the options, this is something where my memory is a little bit fuzzy. So correct me if I'm wrong. And I know that some of you guys in chat know this, so correct me if I'm wrong. The price that you get on the options expiration, like if you hold the option for expiration, is actually the opening price of it next Monday, right? So the market makers have to hold the inventory over the weekend, essentially. Which is why when Monday, Tuesday comes along, then they don't need those hedges anymore and they just dump them. So this is called the unclenching. And you'll note where you go back and you look at charts and you chart when the options expiration is, you find that actually could we do that? Hold on a second. Yes. Phased expiration. Hit next rollover date. I'm going to see if ChatGPT... actually, let's do Gemini. I'm going to see if Gemini can do this. It says to use a while loop. Okay, fine. I'm not going to copy its logic. I'm going to do it myself. We'll copy that line. Like that. It still does it with a while loop. Oh, okay. I like this. I like it better. If today dot day minus 1 divided by 7 plus 1 equals 3. Return true. Okay, fine. Actually, its code is better. Oh, wait. Public pool is third Friday. Date time today. if is third Friday times 0 Hmm. Oh, didn't work. All right, so first of all, I wonder if that is incorrect. Da-da-da-da. Okay. So now we can discuss what I was talking about. Do you see? Here's an options expiration. Moves up into the expiration. Afterwards, not so good. Okay. Moves up into the expiration. Slows down a little bit. Okay. Moves up into the expiration. Struggles after the expiration. Okay, this one in November was a little bit different. It was doing the same thing, but then things kind of got ruined right at the end. Right? Okay, December, also similar here. Okay, this one moved up into expiration. This one moved up into expiration and then giddish. Moved up into expiration. Giddish, giddish, giddish. Really, really bad. So for that, why isn't it not picking up the April one? Probably because the options expiration in April happened on a Thursday, right? I think so. So, you can see that there's nuance about what's happening in that specific situation, but very clear that weird things happen going into options expirations. And so in this situation, I would expect them to continue trying to buy. I don't think, well, so right now, if we took that in the S&P 500, it looks like that we would be in a position, but it hasn't gone very far or done much of anything yet. I would not expect to see, if they're going to do that, wouldn't expect to see it until later in the day. Okay. I think that I could make a better version of this indicator. Maybe we'll do that another time. I could say, okay, if it's now past the third Friday, then I just put it on the last day, because so that it would fix that April issue. And I don't think that that would work on an intraday chart. If we did that on an intraday chart, it would basically put a line at every bar. So there's problems with that indicator. All right. Now, APAL says, up a quick 150 on my other account. Also got a success email. They say it's a live sim account until you reach the target, and that amount will be credited to funded. Yes. Which is what we knew about them. Oh, by the way, that reminds me, though. I found out about a new prop firm. Or rather, I got an email from a new prop firm. And this one sounded interesting. Where's my notes? Guess I'm making a new one of these, even though. Okay. Our notes on all of the prop firms. The name of this prop firm is Funded Next. There's Next Gen Futures, but not. I don't have Funded Next on there. Let's go look. I'll read to you this guy's, what he said to me. What makes Funded Next Futures unique? A 100% profit split, no cap on performance rewards, 15% reward from the challenge phase, no activation fee, and 0 monthly subscription fees. So you're saying that you only pay for the funded for the challenge, If you win the challenge, you get a 15% reward. And then after that, there's no activation fee and no monthly subscription. You just trade after that, and there's no cost to you. That seems like a significant improvement from other platforms, doesn't it? No time limits. Oh, maybe when they say there's no, maybe that just means when I sign up for the thing, if it takes me more than a month, I don't get charged the second time. Maybe. News trading. Oi. Okay, so the big downer on that one is it's MT Trader. C Trader and Match Trader, I've never heard of them. Never heard of them. Oh, those are CFDs. Trade of 8, Ninja Trader, and Trading View. Okay. Okay. All right, here we go. Okay. Now that's interesting. So they have a much cheaper plan than other people, don't they? So $129 for one that gives you $12.50. Then you can have 2 minis on them. Dude, to make $1,000 on 2 e-mini contracts is... See, APOL would have already passed it 3 times. How many contracts were you trading, APOL? Were you doing more than 2? Futures. Okay, they do have a consistency rule. Maximum loss limit resets to initial balance after the first performance reward withdrawal. That's kind of cool. Funded next account. Doesn't say, but it seems to me that they are in the sim only. Oh, here we go. Funded next accounts are simulated accounts. Oh, and Octavia says you can't trade bonds. Yeah, and then that one doesn't surprise me. Well, all right, guys. Well, I feel like that we had a really productive session. Interestingly enough, Friday was the most productive of the week. So, good luck with the options expiration, guys. We will be back on Monday. In the meantime, stay excellent, team.